Damien Courvalin, Goldman Sachs head of energy research, joins us now. How do you get there?
Sure. So the key really here is how to deal with the uncertainty of the virus. The best precedent we have is the SARS epidemic in 2003. And so what we looked at is what would that do to today's oil market? Keep in mind, Asia went from 28% of demand to 42% of demand since then. So we take that precedent, we scale it up, and we end up with this 300,000 barrels per day impact on demand, mostly travel. And in the end, on our modeling, that's a $3 impact on oil prices. So
the Asia makes up more of the total demand now, but obviously we all hope, and thus far it's the case, that this isn't as big a restriction on travel as the SARS virus ended up being.
Exactly. That's the key uncertainty, is how virulent this virus will be, how will it spread, and the policy response itself, right? An aggressive upfront policy response may shorten the extent of the outbreak itself. Now, again, because Asia has become such an important source of oil demand, it still would have an impact overall. And I think the key really is the uncertainty around it.
And does it only have a negative impact because Asia is a predominant, it is always in demand of oil, but not necessarily a big supply? If this spread to other regions that were supply regions, could it possibly have the opposite impact?
So potentially it could have an impact, although oil production is not labor intensive, relatively automated or isolated. So really here we're focusing on the demand risk. And I think going back to the SARS epidemic, what was key at the time really was the uncertainty exacerbated the move in oil prices, right? Oil got hit more than GDP, but the 20% decline we had then was far in excess of the eventual hit to oil demand.
And what about supply? I mean, where do things stand right now for supply? And is it possible that the producers would just cut back more if we had a short-term disruption in demand?
Yeah, that's a very good point, right? If you look at OPEC's behavior, they're cutting output. When demand gets hit, they have every incentive to continue, if not extend, their output cuts. And even if you look at U.S. producers, right, they're very disciplined today at lower oil prices. They would likely pare back activity further. So again, if this is a manageable demand hit, and the supply side remains relatively robust, the outcome for oil prices in the end should be relatively benign.
I was going to say Brent is already down about $3 in the past few days, right? So I mean, if that's essentially the magnitude of the potential impact, is it already in the market?
So that would be our math, right? The market has effectively priced SARS, which is really what we can relate to. Anything beyond that would have to be on evidence that this is spreading even further.
Why do you think that oil's getting hit rather than other risk assets?
So it goes back to the transportation element. Look at the policy response. It's a transportation ban, direct impact on air travel, gasoline demand. And that's why, back to SARS, the hit on transportation was much larger than the actual hit on GDP in the end.